This all starts with a deeply unfortunate situation. You're a homeowner who is facing foreclosure. Maybe the house is actually in foreclosure and going through the process. Maybe you're months behind on your mortgage and it doesn't look like there's a way out. But maybe there is with BlueHub's Sun mortgage program, if it's actually the Hail Mary that it looks to be on the outside. That's a big maybe, consuming courts, lawmakers, and regulators for years. The program promises to give a second chance to homeowners in dire straits, citing hundreds of households saved from losing their homes. And BlueHub has received plenty of plaudits for its work. But some homeowners, mortgage, and consumer protection groups paint a darker picture as well, that the program is actually hiding the ball and taking advantage of the people it claims to help. I'm Jennifer Smith, and this is the Codcast, CommonWealth Beacon's policy podcast on politics and civic life here in Massachusetts. I'm joined by Elyse Cherry, CEO of BlueHub Capital. Thank you so much for being here, Elyse. Are you ready to kind of break this down?
I absolutely am, and thanks very much, Jennifer. I'm delighted to be here, partly because I do think it needs to be broken down, and we need to set the record straight.
Great. So we'll get into the mechanics of the program in just a second, but why don't we start? Tell me what the purpose of the Sun program is at its core.
Sure. Let me, I think, take a bit of a step back from that and tell you a bit about BlueHub so that you have some context as to how this all got started. So BlueHub is what's known as a community development financial institution. We've been around for 40 years. We started with a grand total of $3,500 from the Old South Church Social Action Committee. And by now, we have actually managed to do better than $3 billion in loans. And we've leveraged, meaning we've gotten conventional bankers to join us for another $17 billion. So what do we do with that money? We finance affordable housing, we finance schools, we finance daycare centers, healthcare centers, all of the things that help build healthy communities, because that's actually our mission, to help build healthy communities where low-income people live and work. So when we put together the Sun program, it was in the middle of the Great Recession. And people, I think, have to be of a certain age in order to remember really what the Great Recession was about. But part of what happened, not just here in Massachusetts, but across the country, is that the value of people's homes plummeted. And so you could have a home that maybe you had paid $500,000 for, maybe you had a $500,000 mortgage, and the home was now worth $300,000. The other problem was that lots of people were losing their jobs, and so they couldn't pay their mortgages. And so we had people all over the country being tossed out of their homes, put on the street, because if you have a mortgage, you've borrowed money and you have to pay the money back. And for good reason or bad, they couldn't pay the money back. So we set out to try and do something about that because we knew that lots and lots of the people who were being impacted by this were lower income folks. And so we went off to the lenders and we said, I'll tell you what. You've got a $500,000 mortgage, but the home's only worth $300,000. How about you just sell it to us at the lower price? And because nobody's going to give you $5, right? And we'll sell it back to the homeowner. And you know what they said? Not on your life. We will never do that. And the reason, and we have this in writing from them too, although at the time it was really just an oral arrangement. And the reason for that was they said, if we allow people to stay in their homes and not pay their full mortgage, why would anybody pay a mortgage?
Yeah, it's the concept of a moral hazard, if people are familiar with that.
Exactly. And I'm on record actually going back then saying that's just hogwash. People will pay their mortgages. But of course, nobody believed me. Nobody agreed with me. So the arrangement we came to with the lenders was they would agree, something they had no interest in doing, to sell us the home for a lower price in return for the homeowner giving up some of the appreciation. And that's where the idea of shared appreciation came from. But I really want to get at this a little more closely because I think the facts of this have really been lost. You know, this because in fact, and I'll go through this in more detail, every single homeowner who has shared appreciation mortgage is better off than they would have been had they just paid their regular mortgage.
So we're going to go through the mechanics, I think, because it can be helpful for people to understand specifically what this looks like in practice. So to try and deal with it concisely, and you can let me know if this is accurate. So a homeowner is facing foreclosure.
Yeah.
BlueHub, through subsidiaries, buys out the home before or after foreclosure, sells it back to the owner for 25% more than what was paid for it. This is backed by a mortgage from another of these entities, and most homeowners also take on what you've referred to, which is this second mortgage known as a shared appreciation mortgage. And this basically says the owner is obligated to pay a percentage of any future home appreciation if they want to sell or refinance the property. So on the kind of very high-level mechanics, that's accurate, right? Just so people can understand how this goes.
I wouldn't say so.
Okay.
And here's why. Okay, in my example, the challenge is mortgage finance is complicated. But in my example, okay, there's a mortgage for $500,000, and the home has a market value of $300,000. For the mortgagee, that is the lender, to get the value of that home, they have to kick out. They have to evict the homeowner. So they're not really going to get $300,000. They're going to get, just as a good number, say $250,000. So what we said to them was, look, let us buy it from you for the $250,000. We'll sell it back, and then once we've done that, it regains its market value because we don't have to kick out the homeowner. We're selling it back to the homeowner, right? So the homeowner winds up with a loan of about $300,000. But the most important point, and this is the point I think that has gotten lost, is the homeowner had a $500,000 mortgage. They owed $500,000. Now, all they owe is $300,000. They have been released from the prior mortgage. And so I look at this and I say, this is going to be the first time in the history of mortgage finance that a borrower winds up owing substantially less money to the lender, and it's still called predatory. It just makes no sense. The other point I want to make here, and again, I fully recognize that mortgage finance is complicated, but let's think for a second about appreciation, okay? If I have a $500,000 mortgage, I don't earn a dime of appreciation until that mortgage gets to be $501,000, right? But if I now have a $300,000 mortgage, I start earning at $301,000. So in this example, where the homeowner is paying 60% of its original mortgage, which is, I can show you 20 of them. In fact, the homeowner, by the time they get to what they had originally owed, has already got, even with a share, they've got $120,000 of appreciation that they never would have had. Not only are they in their home, they're not in the street, they have full ownership, but they have such a lower mortgage, they've been released from the additional $200,000, and they're way ahead on appreciation by the time they get to where they would have been had they just paid their mortgage. And that's not being reported, which is very frustrating, as you might imagine, because at our core, we are entirely a nonprofit, and we exist, as I said, to help build healthy communities where low-income people live and work. So to have it reported in these other ways is very frustrating. The other thing I would say is there is a real equity issue here, and that involves the neighbors. Right? So imagine you're living in a neighborhood, you have a $500,000 mortgage, your neighbor has a $500,000 mortgage, you fail to pay yours for good reason or bad, you come to BlueHub Sun, we give you a second chance now with a $300,000 mortgage. Your poor neighbor, who's taken on additional Uber rides and put more rice in the pot, I've heard many of these stories, doesn't earn a dime of appreciation until they get above $500,000. That, I think, is the real equitable issue.
And so there are two major reasons we're talking about this today. Timing-wise, a judge recently, considering a years-long suit, I think it's 2020, it's been going for more than, at this point, half a decade, and it was brought by some of the homeowners who use the Blue Sun program, and they said that they didn't understand what they were signing up for, specifically that question of the SAMs, that they said that they weren't aware that there would be such a large payment coming down the pike later. And the judge ruled on summary judgment, so there are other issues that will be left for trial, on a few different notes, including that the program violated predatory lending statutes and other lending laws, but that the actual terms that these homeowners were presented with were not, as a matter of law, unconscionable or unfair. There are other things that will be sorted out here. I think I'd like to first sort of get your reaction to this ruling and what you anticipate next steps to be.
Sure. Well, let me just say right up front, we think the judge is dead wrong. We do not think it's predatory. As I say, I cannot imagine how a loan could be characterized as predatory when the people the borrowers owe less money than they owed in the first place. The judge seems to have looked at this as a kind of a classic refinance. It's not that at all. What we're really talking about are people who are in foreclosure, who were in the verge of losing their homes and being evicted, who wound up owing less money than they owed if they just paid their loan. So we think it's completely wrong on that front. The judge also said that 93A applied. We think that's completely wrong, too.
So that's the consumer protection
statute.
That's right,
the consumer protection statute. Yes. So 93A, there were two analyses about that. Nonprofits, as a general matter, are exempt from 93A because what we do is not viewed as being in trade or commerce. And that is exactly what we think. The work that we're doing with Sun is completely consistent with all of the other work that we do. There is an exception to that for nonprofits who have some sidebar going on, which might be commercial. That's not what we do. So we think the judge is just dead wrong on that subject.
And so to clarify that, and I'll let you continue, but just in case everybody doesn't spend their time thinking about the minutia of 93A consumer protection laws, what you're talking about there is a charitable exemption that
That's
is
correct.
Carved out as part of that. And so the judge's perspective on it was that BlueHub is sort of inherently engaged in the flow of commerce, that you're involved in the homeownership market, that the kind of bases for the ways that these mortgages are calculated out is with lenders in mind. So the idea is this is a commercial business even with a charitable goal. So, of course, that's the thing that you dispute.
Yes, we think that's dead wrong. We are clearly a nonprofit. We've been a nonprofit for 40 years. We're part of an industry that does lots of this work, most of which is nonprofit. We just think they're wrong. And, the other thing I would say here is this is not the plaintiff's first bite at the apple, right? They went through the Division of Banks and said, hey, wait a minute, these are terrible loans. You know what the Division of Banks said? No, it isn't, right? And so we've been through the regulatory process. We did go to get legislation because we want this clear going forward. But part of what we said in the legislation is, Attorney General, please create some regs about this so that there's some clarity. We do a ton of disclosure, right? We do it now in videos. We do it in writing. We do it several times over the course of it takes months to actually get these transactions done because you have to negotiate with the lender. So lots and lots and lots and lots of disclosure. And so, if somebody wants to say to us, disclose differently, I'm fine with that. I don't have any trouble at all. We have never tried to hide the ball on this. And as I say, the thing that was left out of the decision, which I find so troubling, is that every single one of these plaintiffs is better off than they would have been had they just paid their mortgage.
So this is really interesting to me, maybe not as a matter of law, but as sort of a conceptual matter here, which is, it sounds to me sort of like the argument is that there can't be a predatory lending practice if you are better off at the end of it. Is that sort of the core of what you're saying? Because my understanding was that the objection was that maybe they understood the full terms of the first mortgage, but for reasons which, of course, are messy and under dispute, say that they were not aware that this came with the shared appreciation mortgage that kind of left them with this big payment later. And of course, as noted, the judge did say, well, you can't just not read a contract and claim that you didn't understand the terms of it. But what the judge did say is the way that these loans are set up, which they felt should be one loan, is you might agree to this first part without understanding that there's another shoe dropping down the line. So I guess I'm just curious about your perspective on whether or not there can be predatory practices, even if, technically speaking, the person might end up in better situations than they were in if the practice hadn't occurred.
I think what I would say to that is I think this is true of virtually every plaintiff. They were represented. They were either represented by counsel who was very familiar with what we were doing, or they were represented by housing counselors who were very familiar with what we were doing. Because all of our borrowers, not all, but most of our borrowers came in through housing counselors, through the Attorney General's office, through the mayors, through the reps. We're all over the press about what we're doing, and these folks were working with people who represented them who knew exactly what we were doing. In fact, there were plaintiffs who, in the context of their interrogatory, said, yes, I understood what it was, I just don't want to pay it. So no, I don't think for a second that, as I say, we disclosed several times over the course of those months. And I understand time has now gone by and people's memories fail and fade maybe. And, at the time they were desperate to own their homes, and now they say, oh, geez. But we don't think that's true at all. I can produce all kinds of staff members who say, what are you talking about? Of course I went through this. And not just went through it orally, went through it in writing, now go through it in video. So it's hard to understand.
And so I'm glad that you brought up the legislation, because the other reason that we're talking about this today is there was initially an attempt in 2022 that ended up being successfully included in an economic development bill in 2024 that has language that does not name BlueHub by name, but in practice exempts from liability nonprofits that engage in these shared appreciation mortgages, which I believe solely covers BlueHub in the state of Massachusetts. And you testified in favor of this. You were in favor of this legislation, and it's saying you're exempted from liability if you make certain obligatory disclosures, an array of possible additional ones, and then says that the Attorney General can put forward rules and regulations to basically make sure that this legislation is effectuated correctly. So I have to start with the perhaps broadest one, which is, how did this legislation come to be from your perspective? What was the push from? Because it does seem so narrowly tailored that it does seem like that had to come from somewhere.
Oh, no, we actually absolutely have been pushing that legislation. But let me get to the narrowly tailored question. The question that never gets asked here is, where are our competitors? Right? Do you know a single business, if it's successful and if it makes money, that someone else doesn't say, wait a minute, I can do this for cheaper? Where are our competitors? There is no one who's out there doing this. And you know why? Because we haven't made money at it, because it's incredibly risky, because it's difficult to do, because we have to manually underwrite all of these borrowers. Underwriting mean figure out their ability to pay, when everybody else in the industry is doing this in an automated way. So what we did was essentially to say, look, if we're going to continue to keep homeowners out of foreclosure, and let me just tell you, we have 1,000 families who are in their homes because of BlueHub Sun, right? And in addition to that, notwithstanding all of this analysis, which I think is incorrect, we have managed to put $67 million in equity back into the community. And so, this suit is out there, and we're essentially saying, if we're going to keep going in Massachusetts, and we don't have to, we're in another 10 states as well, we've got to have some clarity here, right? And so what we really did was to ask the legislature to provide that clarity, and then eventually to ask the Attorney General to create a set of regs so that we know where we are. That's why it happened. But again, I would really focus you on this question. If what we were doing, right, was so profitable and so predatory and all of those things, we don't live in an economy where people say, oh, geez, I can't do that, right? We live in an economy where someone says, if they're charging a lot, I could charge less and eat their lunch. That's not what's happened. It's been 15 years. Tell me where our competitors are.
So I'm glad that you raised that, too, because one of the worries around the legislation, right, was, well, depending on what it actually ends up requiring and what the actual end structures of these regulations end up being, it might encourage people to get into the business if, again, in the cynical read of it, if it's a predatory practice, the idea would be, well, you now have carte blanche to engage in a predatory practice. And if it's a deeply unprofitable, civic-oriented program, then you're saying, well, shouldn't we actually maybe want people to be feeling more comfortable to engage in this sort of program or make it easier to run? And I guess my question, just to kind of go back a little bit, which is, was your understanding that this was necessary kind of for clarity in the industry or clarity for BlueHub specifically because you're the only group doing this in Massachusetts?
Well, I think I would say two things. One is, categorically, this is not predatory. Categorically. Okay. The second piece is, if others want to come in, we would welcome them, right? I mean, folks can get capital at cheaper prices than a nonprofit. I'd be delighted if somebody could do this more cheaply because, in fact, we're mission-driven, right? We exist to help build healthy communities where low-income people live and work. So whether we're the only folks today, you really have to ask yourself, why is that the case, right? And as I say, the case is because it is not a business line at which you make lots of money. It just isn't. We have yet to break even when you think about the cost of capital. So it's fine with me if, in fact, there are regulations put in place that allow this to work. And I should say as well, and that others come into the industry. One of the challenges here is today when we make a loan, people mostly are not underwater, meaning their homes are not worth less. What we're worried about is the next downturn. And, one of the advantages, I suppose, of having now spent 40 years at this, we know that markets go up and down. If you've only been at it for 10 years, you think, oh, the market only goes up. Not true. And so when the market goes down again, the question is there going to be somebody around who, with a reasonable level of certainty, can make these loans that keep people in their homes, that put them in a better position financially, and allow, keep them from being evicted?
And one of the other reasons that we were talking about the legislation is the meta discussion about the optics here. The way that this came about, Governor Healy, longtime friend, you've been a longtime donor for her campaigns over the years, did not veto the ultimate legislation, but it wasn't included in her initial economic development proposal. That came about through the legislature. We're campaign finance nerds over here at CommonWealth, so going through donations, of course, you've regularly, in your personal capacity, given plenty of money to legislative leaders, political leaders. Do you worry at all about what that ends up looking like when longtime recipients end up either proposing legislation or supporting legislation that directly benefits you and your program?
Well, let me again take a step back and create some context around this. I think my first political activity was with Governor Dukakis back in the early 1970s. I've been at this a very long time. And one of the reasons that I became very active over time was because I'm also a member of the LGBTQ community. And what we could see was that our interests were not being considered at all because we were really invisible. And so we set out early in, I'm going to say the 90s maybe, to really start focusing on supporting candidates who were friendly to our issues and could understand that we were an important part of the body politic. So I have given money over the years to, I don't know about Governor Dukakis. I didn't have any money in the 1970s, but certainly to Governor Patrick, to the attorneys general, to our representatives, to our Senate our senators, to people in the legislature. And I really don't think that because somebody doesn't like this program, that I ought to have to give up my civic rights in terms of participating in the political world. Because, as I say, it's not just that I've said, oh, Maura, maybe Governor Healy, maybe you can help us with this. This is a very broad approach that I've taken for a long time. I chaired mass equality during our fight for same-sex marriage. We were all over the State House, and that's what we had to do in order to get this done. Now, if you say to me, do I think this is a good way to finance campaigns? The answer is no. We could have quite a conversation about how to do campaign finance. But I live in the real world, right? And so no matter what I think about campaign finance, right now what I know is if I want people to lead our state, whether in the legislative side or the federal side or the executive side, we have an obligation to support them myself, and also support them by doing fundraisers. I've done fundraisers over the years. I'm never going to remember all of them, but for Governor Patrick, for Representative Tsongas, for Governor Healy, for our lieutenant governor. I mean, all over the place. It's part of what I do. And if you think about it, I do it in my personal capacity because, of course, I lead a nonprofit. But it's completely consistent with our mission. The mission is to help build healthy communities where low-income people live and work. I do not want people in office who really are supporting billionaires.
Yeah, I appreciate that answer in part because one thing that came up going through OCPF filings is that your work is often oriented around kind of the experience of the average person that's in a really rough situation. And so that's kind of why I ask about the optics of it, where if someone doesn't have a strong understanding of what maybe political corruption or campaign finance or something actually looks like in practice, do you ever have any concerns that in a situation like this, those sorts of charges, like corruption or political favoritism come up and can damage the work of an organization, I guess kind of in a personal capacity?
I guess what I would say is insults are easy to hurl, right? And there have been a lot hurled. A lot hurled at me personally, and a lot hurled at BlueHub Capital. That is not the basis on which we make our decisions.
And thinking about one of the donations that came up, and you mentioned, of course, attorneys general was back in the day Andrea Campbell, our attorney general here in Massachusetts, who is right now looking at what regulations would be appropriate for this. Many of them seem to be responsive to the lawsuit, so dealing with some of the concerns that have come up in the lawsuit before. I guess I'd like to start by getting your sort of reaction to the regulations on principle, because you did say it would be helpful to have regulations. So what regulations would you have actually liked to see? And then we can talk about what's been proposed.
Sure. So we are, let me just say, very early in the regulatory process, right? The hearing is really the first step. And there'll be lots and lots of meetings, and not just with us. I mean, this sort of sounds like, geez, we're the only people who make contributions. It's just not true, right? I mean, in the grand scheme of things, everybody does a little bit, and that's what we do, or what I do. So in the end, really what we think is that if there's benefit to the borrower, meaning that the borrower owes less at the end of the day than they would have had they simply paid their mortgage like all the rest of us do, right, then that should be sufficient in terms of the content. In terms of disclosures, happy to disclose anything, right? I mean, I would really, really love to have the Attorney General say, disclose it this way. There have been some things proposed that you kind of wonder whether they'll work well or not. So, for example, this notion that there should be a cap. Well, it's true. You could go out 30 years.
So to clarify, when you talk about a cap, you're talking about the idea that there is this chunk of appreciation. And of course, some of that goes toward overhead, some of that goes toward employees, but that regardless of the amount that the value of the house appreciates, that there should be some sort of cap on the amount of that appreciation that BlueHub would then be able to take.
Right. So let's unpack that a little bit, right? If, in fact, let's assume the mortgage goes for 30 years. It mostly doesn't. I want to say that of the 1,000 families that we have helped stay in their homes, what we say to them is refinance as quickly as you can. Clean up your credit, right, so that somebody in the conventional market will work with you. Because right now, they cannot get any mortgage anywhere else because they're in foreclosure. But if you clean up your credit over 2 or 3 years, you can go back into the conventional market. And the second you go back in, that cuts off the shared appreciation, and so you pay quite a small amount of money. If you don't clean up your credit or you continue on, then the shared appreciation grows to the extent that appreciation in the home grows. So let's think about this. Let's take the absolute extreme here. Somebody keeps the mortgage for its full 30 years, and you get to the end of 30 years, and I don't know, let's say, we've had 3% increases every single year, which is seriously unlikely, but let's just say that. But here's the point. That number is gigantic in terms of the shared appreciation, but so is the value of the home, right? So that home, which today may be worth $300,000 or $500,000, is then worth like $5 million, right? And maybe the shared appreciation is 2. I'm making up the numbers. But the point is, that doesn't actually help anybody, because when somebody says to you, in 30 years, your home will be worth $5 million, you just dismiss it, right? So if really what the Attorney General wants to do is say, if this is what happens with appreciation, this will be the value of your home, and this will be the value of the shared appreciation, I'm okay with that. I have serious questions about whether it's actually helpful to people because, are you a homeowner?
Yes, I am.
You are. So, and how long have you owned your home?
I have a mortgage, and I've had my place for almost 10 years now.
10 years. So what you know is that the value of your home, I'm going to guess, is so much higher than you could have imagined 10 years ago.
The housing market is terrifying.
The housing market is terrifying. And so, if somebody says to you, look out 30 years, it's going to be worth this gigantic amount of money, is that helpful?
I guess the thing that I'm curious about here is because we talk about why there are reasons for regulation. And the worry that's come up around practices like this is sort of because of the nature of the people who are being helped by this program. If you offer someone a lifeline, they're going to be inclined to take it. So there's a real risk of predatory practice. And so I wonder, is that a concern? Is that something that regulations could do more to make sure is less likely that somebody says, well, I was told that there might be some value of appreciation later down the line, but I can't conceptualize what 30 years of home appreciation looks like. And so I don't understand what it means if I'm saying, well, I now have to take on this additional second mortgage to kind of shore up this first mortgage that didn't tell me anything about the second mortgage. And it might mean that half of my home appreciation kind of becomes due later on. Is there concern that that might be putting people in a situation where they say, what other options do I have?
Well, let me say a couple things about that. First, it's not what we do, right? Second, as I say, virtually everybody, certainly among the plaintiffs, but most people who come into us have some representation, right? So you are really saying, and I don't disagree with you about this, people have a hard time conceptualizing money over time, right? Because again, 30 years out, when I was growing up, now I sound insanely old, but an ice cream cone was 10 cents or 15 cents. Now it's $8, right? So 30 years from now, if home prices look like that and if shared appreciation looks like that, everything else is going to look like that too, right? An ice cream cone will be, I don't know, $50. So it's hard to have people conceptualize. And I'm totally supportive if other folks want to come into the industry and they have to sort of do this work and they have not a mission-driven focus but a predatory focus. I absolutely think there should be good regs for that. And we're perfectly happy to follow them. All we're really saying here is we want some certainty, right? We think that what the statute did was simply clarify the existing state of the law. There's been all this question about whether it's retroactive. I testified. I don't think it's retroactive. But, what I think is it
Didn't the attorneys argue that, though, that it should be retroactive? I think that's part of the confusion, of course, when you're going through these where the judge noted Elyse went and testified that this isn't retroactive.
Absolutely.
And then you look at the filings and they're saying it should be retroactive, and it makes people a little bit anxious.
I think what they said was that it clarifies the existing state of the law. We don't actually think we've changed anything, right? We don't think we're currently subject to consumer protection because nonprofits are not when the work they do is consistent with their broad work. I mean, we simply don't. But we're looking for clarity because we have folks who are making what we think are outlandish accusations. And we need to be in a position, if we're going to continue to help homeowners, and in some ways more to the point, continue to put equity back into the community. As I say, it's $67 million. People talk a lot about, wealth gaps. We're actually putting it back in. We need clarity to do that.
And I want to kind of put a button on this, which is just quickly saying, what are the next steps for BlueHub in this specific lawsuit? Of course, you're going to continue offering comment to the Attorney General as she considers regulations. What is the next step in the lawsuit? Because you're also trying to spin multiple plates at the same time, and you're advocating for other housing policies as well.
Yes. In fact, we have a statute that is now before the legislature, which is really talking about shared accommodations. And, one of the things we think about is how do you deal with the housing market overall, right? And we have lots of folks around who are aging in large homes, and they're having trouble staying there because they need a little help. And at the same time, we have a ton of people who come in to go to school here and then say, oh, my God, the housing market is so expensive, I can't stay. And so at its base, we say, what if you put those folks together, right, and had cheaper housing for young people, although it isn't limited to younger folks and old folks. There are a million applications for this. But just at its core, cheaper housing for young folks who then offer some help, right? Maybe they mow the lawn, maybe they drive you to church, maybe they do the grocery shopping, maybe they cook a couple days a week, so that we don't have to build new housing for everybody, and it really has a positive impact in the market. We think there are 500,000 empty bedrooms in Massachusetts. If we got 10% of those, 50,000, that would save, it now costs about $500,000 to build a unit. It would save $25 billion in terms of housing expense. And it's part of why folks like the Environmental League of Massachusetts are with us in this, because you save all of the not just the money of building it, but also the environmental impacts of building it. So yeah, we're out all over the place really trying to figure out how to create healthy communities where low-income people live and work. We're consistent with mission.
The shared housing idea is so interesting. I remember when I was a local reporter, there was a City of Boston pilot looking at that, and the question was, how do you pair young people with kind of seniors with too much space for them, but maybe not that kind of capacity? And what came up was the question of if something goes wrong, who's liable? If there's that program, if you're pairing someone with a senior and something goes wrong, what if there's a fall? What if there's some kind of crime? What do you do with that? So how is that factoring into this?
That is exactly why we set up this legislation. Right now, if you come into a senior's home, you could argue you're a tenant, right? We have great tenant protections, but if you're the senior, are you really going to let somebody in if it takes a year to go out again? If somebody falls, what's your insurance policy say, right? Is that covered? If it doesn't work, is there some relief housing available so that you're not just putting the young person in the street? What we discovered is there are, a half a dozen or 10 issues that could be easily solved through legislation and regulation to deal with exactly the issues you're raising, but that doesn't exist today. And so what we're trying to do is to put into place a legislative and then a regulatory oversight here that allows people to do this, but deals with exactly the issues you're raising, right? So say someone came in and they stole from you. You don't want to have to just evict them because that's a year-long process. You want to be able to call someone and say, this person has to leave. And then the youngster says, well, geez, I didn't do it, but, and I don't want to be in the street. And you say, that's okay. We've got some relief housing so that you can go. It also means that, folks, there has to be some vetting up front, not just for the home sharer, but also for the homeowner. And actually, since this is going out to your audience, home sharer is a terrible name for this, and we haven't come up with a better one. So maybe we
It's like the debate over ride share.
Exactly. So maybe we can crowdsource. Anybody who's got a better name for home sharer, let us know, and we will seriously consider it.
Right. Well, and of course, this is part of BlueHub's broader legislative agenda.
Yes.
And I think just to kind of wrap everything up here is, how much of the organization's kind of resource, focus, whatever it is still kind of bound up in the Sun program discussion about SAM mortgages, because I certainly don't expect the debate over the practice to go anywhere in Massachusetts anytime soon.
Sure. So maybe one thing to say is we have several different business lines. We have a loan fund, which, as I indicated earlier, finances schools and affordable housing and daycare centers, grocery stores, all kinds of things. We have a climate practice, which is really lending to loans that have a positive impact on climate. We have something we call 1% for America, which provides very low-cost 1% loans for people trying to attain citizenships as a way to really help them get there. So we do lots and lots of things. The Sun Initiative, broadly speaking, it has several entities, as you indicated, is a small part of what we do. And of course, the plaintiffs are very active and such, but we are very proud of what we do, and we're proud of what we do at the Sun Initiative. There is no one else who did this. There are folks who say, we tried to do it, but no one succeeded in getting lenders to sell homes back to homeowners. They were absolutely opposed to that. And so I sit here and say, I've got 1,000 families who are in their homes as opposed to being on the street, and they are in their homes owing less money overall and less money each month, even with the shared appreciation mortgage, than they would have owed otherwise. And the final thing I would say about that is, I live in a real world. I could not get lenders to work with us on this program without a shared appreciation mortgage. So we can take a kind of a purity approach here and say, you shouldn't do that, and say, okay, do you want to be responsible for those 1,000 families on the street? Because I sure don't. What I want is for people to be in their homes, to be participating in their communities, and to really be part of a healthy community, particularly when they owe less money at the other end.
All right. Well, sadly, as always, that ends up being all the time that we have. But Elyse Cherry, thank you so much for being here.
Well, and thank you so much. And particularly thank you for your great preparation on this. Really, really, really deep understanding of the decision. Thanks again to Elyse Cherry for joining me on the Codcast. Thank you so much for listening.
I'm Jennifer Smith. Our producer is Charlie Cazella. Our theme music is also by Charlie Cazella. Leave a rating and review wherever you're hearing this now if you want to help other folks find us, and email codcast@commonwealthbeacon.org if you ever want to get in touch directly. We'll be back in your ears next week.